Curious which mortgage product is the right one for you as a home buyer? Be it your primary or secondary residence, there's options out there for everybody. We're going to run through what those options are, what the most common ones are that buyers use, and we're going to take a look at which ones for what buyers are the right ones. Now, the first mortgage product that most people think of when it comes to home buying is the conventional loan. Now, a conventional loan is issued by private lenders or banks, but it follows the government guidelines from Freddie Mae, Fannie Mac, and the Federal Housing Finance Administration to set who qualifies for the loan. Now, these are not government-backed loans, but they do follow the parameters set forth by the government entities, Fannie Mae, Freddie Mac, and the Federal Housing Finance Administration. So what does that mean? Well, as private lenders, they can lend to whomever they'd like, but by setting the parameters to be the same as the government, they set it across the board way to get a loan. So what are the most common ways to be able to qualify for one of these loans? Well, the higher credit score you have, the lower interest rate you're going to get. You're going to need a debt to income ratio of anywhere from 30 to 35, maybe 40%. You're going to need to have substantial assets or enough assets to show that you have the wherewithal to pay for the home. And you're going to need to provide a W-2 or some other form of verification of employment so that they know that you have a constant source of income. For a W-2 employee, this is really easy to do. For a self-employed person, it's a little bit more challenging and more paperwork involved, but we can help guide you through that with one of our lenders or a lender of your choice. Now, with a conforming conventional loan, 20% down is not the set golden rule. That is what a standard is, which allows a home buyer to not pay an additional monthly fee called the private mortgage insurance. This fee, it's an additional amount put on top of your mortgage payment to accommodate and account for the risk taken on by the lender. It is normally about 0.5% to 1.5% of the overall loan cost, and it's added on the monthly payment up until you hit 20% down payment on the home, at which point it's taken off. So using PMI, while it adds a little bit more on your monthly payment, it does allow you to keep more money in the bank when buying a home, which can help with improvements, furniture, updates, any sort of thing that you may need that you want to keep cash in the bank instead of at the bank. This might be right for you. So with conventional loans, as I said, we have both conforming and non-conforming. We discussed the conforming loan limit. It's right up the fairway, pretty typical loan. So what's a non-conforming loan limit or a non-conforming loan? Non-conforming loan is one that exceeds the lending maximum set forth by the Federal Finance Housing Administration. So these are known as jumbo loans. Typically, they will require more wherewithal, right? So a higher earnings, higher amount of assets showing capacity. So greater assets, you're going to need great credit score to get the best rates. And you're going to need to put at least 20% down, if not 25 or 30%. These can be used on secondary, primary residences also. So for people looking for a second home, they're a great option. So when we're looking at alternatives outside of the conventional conforming or non-conforming loans, we have government-backed loans, right? So one of the most common ones of these is the FHA. The FHA loan is a government-backed or government-guaranteed loan. Great for buyers who may have a ding on their credit report that dropped a little bit. They've got generally strong credit, but they have a couple marks that lower their score enough to where they're below the 700 mark, below the 650 mark, that sort of thing. They're going to pay a little bit of a higher interest rate, but they're going to be able to get the loan. Additionally, there are earning caps on an FHA loan. So you need to be able to qualify by having a income that is under a certain threshold set forth by the government on an annual basis. If you meet these two criteria, or if you meet the income threshold but your credit score is great, then it could be a great option for you and allow you to get into a home for a lot less. The down payment requirements for an FHA loan are considerably less than that would be on a conforming or conventional loan. Sometimes down 5% will get you into a home, allowing you to have more money in your bank for improvements, updates, that sort of thing. They will also come along with the PMI additional charge on a monthly basis. One of the best loan products for a military vet or an active military member is the VA loan. The VA loan is not available to everyone, but if you do qualify for it, it can be a great resource for home buyers, as it can have all the way down to 0% down payment, which is nuts. So you're basically buying a home without any money out of pocket other than the closing costs. You have lower rates and you have no buy-in loan limit. So it's tough to qualify for. You got to have some parameters around being a vet or an active military member. But if you do, they're a great option and one to definitely discuss with your lender and see if it could be a good fit for you. So there you go. Those are some of the most common mortgage products. Does it cover all of them? No. By no means is that all of the options out there. We have adjustable rate mortgages. We have 203K mortgages. We've got hard money lending. There's all sorts of options out there that outside of these that may be a good fit, but they're a little more niche. And so if you think some of the ones we talked about don't fit you, let's have that discussion and we'll get with our lender and find out which ones do. Home buying's a ton of fun. Get out there, make sure you're well qualified, get a pre-approval letter, and then get out there and go shopping for your dream home.